Good morning. I would like to call this meeting to order. Would you please all rise and join me in the Pledge of Allegiance? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you all very much. Hi. I am Brad Anderson, and it's my pleasure to welcome all of you to today's very special meeting. This portion of our meeting is being recorded. We will be posting it on NSBAR.org, as well as emailing it and sharing it with all of our members and fans on social media. Allow me to introduce our guests. Joining us for the first part of today's meeting are NSBAR's Board of Directors, our past presidents, our committee chairs, our finance committee, and our staff. Thank you all for joining us. They are all here because of our guest speaker. Dr. Lawrence Yun is the Chief Economist and Senior Vice President of Research at the National Association of Realtors. He oversees and is responsible for a wide range of research activity for the association, including NAR's existing home sales statistics, Affordability Index, the Home Buyers and Sellers Profile Report, and he regularly provides commentary on real estate market trends for its 1.4 million realtor members. We have invited Dr. Yun to give us a presentation about the economy and how real estate is performing. His insights are profound and will give us a great glimpse at our industry for the balance of 2021. We are so pleased to have him join us. After a short presentation by Dr. Yun, our CEO, Jeff Lasky, will be asking a few questions from our board and those sent to him from the audience as time permits. Jeff will explain exactly how that will be done after his presentation. Dr. Yun, welcome, and thank you for visiting.
President Brad, for inviting me to share some thoughts with the great people in the northern section of Chicago. I miss Chicago, as you know. The headquarters is in Chicago, downtown, the Michigan Avenue address. I am in DC or I should say Arlington, Virginia. The office will be in DC. Currently, DC building is boarded up because there's still National Guards, and just in case, I guess, our building is just 2 blocks from the U.S. Capitol. So at some time where you are able to come to DC, please visit the DC building, because we are in a strategically important area, but also at the roof, you get a great glimpse of the U.S. Capitol. But 2020 was certainly a year to remember. I mean, this is a story that we will be telling our grandchildren, very, very unique. When 2020 started out, I remember a report from Goldman Sachs, Wall Street company, to say that U.S. economy is so strong, even the underlying factors, they're ready to burst out even more. Nothing could derail the U.S. economy in 2020, which happens to be a presidential election year. So that was a report that came out from Goldman Sachs at January 2020. And of course, everything went upside down once the pandemic hit the U.S. With the lockdown, and great concern in the initial months as your clients disappear, people stay in shelter. How are you going to outlast the pandemic? But when the economy reopened, and good that real estate was considered essential so that you could conduct your business, buyers just rushed in, and towards the year end with record low mortgage rate, trying to take advantage. Another interesting trend was people were seeking larger size home. Maybe people are sensing that work from home flexibility could be in place even after the vaccine distribution. And if that is the case, and one does not have to commute to downtown every single day, then why have homes so close to downtown? maybe that could be further out. And I have heard, before the pandemic, some of the wealthier neighborhood in the outlying suburbs in Chicago, massive price declines, $2 million home getting shaved to $1.4 million in order to attract buyers. But things quickly turned around when the silver lining of the pandemic, as people are seeking larger size home, people are going further out away from downtown. So that has greatly lifted the demand out in the suburbs. So we discuss with slides. So let me put that onto the screen. Okay, so let's go. So let me first start with the job market. And this is a 20-year chart. For some of you who have listened to me in the past year, you probably have seen this chart. I'm updating each month. So what it shows is that first, that we have had 10 straight years of consistent job creation after the foreclosure crisis of 2010. So first question becomes, given the heated market condition today in housing market, are we in another bubble and ready for potential foreclosure crisis? And the answer is, well, the reason for the foreclosure crisis back in 2010 was we had those funny mortgages that overstretched people's budget, no income documentation, and also the builders were building right and left everywhere, oversupply. So you had a combination of mortgage implosion, oversupply, price declines, and foreclosures. Today, the underlying factors are completely different. As you know, we have a housing shortage. The builders have not been active. That's why inventory levels are very low. And also on the mortgage, we don't have those subprime lending anymore. All the people who are buying home, they are taking out a 30-year fixed rate mortgage with sound underwritten criteria. So no completely different basis now versus then. When we had the lockdown and stay in shelter orders, the economy collapsed. 10 years of job creation disappearing in a single month. So 10 years of progress, boom, out the window in a single month. But when the governors began to reopen the economy, jobs started to come around. But if you look at the past 3 dotted line, it's no longer increasing, it's sort of stuck. And we still need another 10 million jobs just to get us back up to the pre-pandemic level. And another way to look at the job number is look at the month-to-month change. So April is the lockdown period, 20 million job losses. Then the first stimulus at least provided some support. So the jobs were being created from the first stimulus. But as you can see, the jobs were fizzling out, which is the reason why President Trump signed into law the second stimulus at the end of December, which is the reason why many people have additional $600 in their bank account. President Biden said that is insufficient. He wants to raise that amount. So for most people, they may be getting additional $1,400 very soon. And other measures, small business loans, unemployment insurance extension, and so forth. So the second stimulus, late December, now likely third stimulus under President Biden, all is trying to help fix the economy as the jobs were fizzling out. The second half of the year looks fine because by second half of the year, most of Americans should be vaccinated. I mean, medical experts believe half of America by summer, another quarter by autumn. At that point, 75% vaccination, that's a herd immunity, and back to normalcy. Go to the indoor dining, go see the Chicago Bears play in person, all that, everything coming back to normal, perhaps by end of this year. So at least we're moving. So second half looks good. It's just the first half trying to get this stimulus, trying to get that jobs clicking again. If we look at the greater Chicago area, so this would cover the Chicago city and I guess various suburbs around it. And what you note related to the Chicago market is that first 10 years, from year 2000 to 2010, there was actually no job growth at all. The rest of the country saw some job growth, but there was no job growth. And when there was a foreclosure crisis, you went down. But from about 2014, there was some job creation coming along, and then you sank during the lockdown. So again, let me go back to the US as a reference. So this is the US. So from year 2000, foreclosure crisis, lockdown, it looks like at the same low point. But if you look at the Chicago area, it is going below year 2000 levels. You see what's happening. So underperformance, relatively speaking. If we look at specifically at Lake County, and I'm not sure if you're bearing the North Shore covers this or not, and Kenosha County in Wisconsin, it resembles more like the US. So greater Chicago area sort of lagging behind the US, but the Lake County and Kenosha County combined is sort of matching the national trend. State by state comparison. Illinois, well, Chicagoland, I think, comprised about 2/3 of the state of Illinois in terms of population. So, that will be driven by the Chicago area. So it's down 6.9% in terms of jobs from 1 year ago, most recently available data. So 6.9%. You see Minnesota, Wisconsin, Michigan down, New York down. California is also down. But southern states, job declines are much more minimal. It could be partly weather related. That is to say that in southern states, you can have outdoor dining for a longer period. In northern states, it's very cold. So that could be a factor. But I would also say that the governor's decision is also contributing. Generally speaking, southern states, Pennsylvania, New York, Michigan, Illinois, all had a very strict lockdown for a longer period. I know real estate was essential, but overall, there was a stricter lockdown. And stricter lockdown means less economic activity. Only 2 states to have more jobs today versus 1 year ago is Idaho and Utah. There, they know coronavirus is dangerous, but the governors there said, we're not going to shut the economy down. We have to get the economy going. So they're just asking people to put on masks, social distancing. So there is actual job creation in Idaho and Utah, or I should say more jobs today compared to pre-pandemic. So that's the situation. One unique aspect of the current economic downturn is the following. GDP is a measurement that everyone focuses as a bottom line figure for the economy. And it's down because of a recession, second quarter specifically. But if you look at the right-hand column, personal income, total income in the country, it is actually above 1 year ago. This is the first recession in American history, where during a recession, average American have more income now compared to the year before. I want to qualify that statement by saying we know many families who are in food bank, who are struggling paycheck to paycheck if they have a paycheck. So we know many families who are struggling. But on average, first time ever during a recession, Americans actually have more income, partly due to the stimulus, enhanced unemployment checks, small business loans, which people do not have to repay if you meet certain criteria, all that. So more income on average. What are people doing with this income? They're not spending it. First, they cannot travel freely. The restaurants are cautious. So people have been saving this money. All the major banks are reporting huge deposits. The amount of the deposit at banks are just sizable and rising, which means that all this savings could be unleashed back into the economy once people say, okay, life is coming back to normal, people are vaccinated, so there could be a big boost to the economic activity, say from the second half of this year as all this savings gets unleashed back into the economy. Let me now turn to the good news of the housing market. So housing market during the lockdown went down, but look how it came back. Not only did it come back to the pre-pandemic levels, but it went way above and beyond, doing better than what it had been pre-pandemic. So you look at the November sales data, December, January, all the figures showing about 20% above comparable period the 1 year before. So dramatic U-turn in the home sales. And if we look at where the home sales are truly growing, higher price point, bigger sales. So this is just a percentage change. Maybe $1 million homes, the base level was very low 1 year ago. So, so homes, 20 homes 1 year ago, now showing 40 home transactions. Well, that's 100% increase. So it could be due to the low base figure 1 year ago, but this graph clearly shows that upper end is moving a little better than the lower end. Lower end, they're being hampered by lack of inventory. While the upper end, there is still some inventory which makes the market move, but the lower end price just simply not sufficient inventory. With the strong sales activity, prices are getting pushed up. So price appreciation is in double digits. I think the latest is showing about 12% price appreciation from 1 year before. But please note that part of the price increases are due to the skewing of the data towards the upper end. So if more upper end sales are being done, then the median prices are being dragged along higher from that. So it's not a true price appreciation of homeowner sitting at home and saying, oh, did my prices rise 12%? And answer is probably not. The median prices are clicking a little higher because of the upper end market. Inventory, all-time low, record low conditions. Are we going to get any inventory relief? And the answer is, we will not get back to the balanced market in 2021, but we may get a little more inventory in 2021 because the builders, single family housing start is beginning to break out higher. In January, builders built a little less, but that was due to maybe weather activity and snowy conditions, but their housing permit, their desire to produce is still rising. So we are seeing a breakout higher on the single family housing start, which is implying that more inventory should steadily appear as we proceed through the year. Multifamily, whether apartments, condominiums, essentially flat because consumers have clearly tilted towards single family homes and away from condominium style of living because of the pandemic. And let me show you this to give you some comfort level on my forecast. So likely path for home sales growth in 2021. So in the first quarter, is it going to be up 20%? And I would say probably, because pending contracts, all those indicators are saying about 20% increase. So first quarter data, I feel comfortable. Then in the second quarter, 50% growth. But this is the fact that second quarter of last year we were in a lockdown. So very few transactions. So low base, you have a 50% growth. And by the third quarter, essentially no growth. And assuming the fourth quarter is a little light, slight decline from what happened the fourth quarter of 2020. If we assume that this appears fairly reasonable, what would you get is that in 2021, home sales on an annual basis will be 15% higher. 15% higher in 2021 versus 2020. So people who are measuring accounting on a 12-month calendar basis, it's gonna be a very solid year for housing market. But one concern is rising mortgage rates. Mortgage rate is always the important instrument that drives home sales. The red is the mortgage rates. Even under 3%, 2.7% in December, 2.7% in January, but now beginning to inch higher. And soon it may actually go above 3%. And by middle of the year, it may even be 3.1, 3.2%. Why? Well, because the 10-year treasury yield, which is the blue line, is already rising. And not necessarily one-to-one relationship, but both lines generally moves together. So if the 10-year borrowing rates are rising, mortgage rate will inevitably rise. So why is the 10-year treasury rising? Well, some people say better economic prospect in the second half, so people do not have to dump their money into safe asset. So people are saying that. Other people are saying, well, you have a stimulus on top of stimulus on top of stimulus. That's a massive blowout in federal budget deficit, national debt, printing of the money, inflationary pressure in the future. All this is saying 10-year bond investors are beginning to act up. We feel uncomfortable about these prospects. We need slightly higher interest rate to compensate for this uncertainty, risk of debt getting out of control. So However you look at it, 10-year treasury is rising, which means that mortgage rate will inevitably follow that path. So again, the absolute low point in mortgage rate is probably already done and over with. It's a matter of how fast the mortgage rate will rise. My guess is that by middle of the year, 3.1, 3.2% average, nothing alarming. I mean, it would essentially match the last year's levels, but we missed for some of your clients that may have missed the absolute low point, but they're still getting good interest rate and should not derail the housing market performance, but something that we still need to be mindful of potential possibility. Let me quickly wrap it up to say office market is really struggling. And maybe this is due to the fact that office worker truly believes there will be no return to 5 days a week come to downtown Chicago. Those days may be completely over. Maybe there's some kind of hybrid. Come to office 2 or 3 days a week, but on Mondays and Friday, work from home. And if people can work from home through this longer weekend so that they make it out, that means greater demand for housing further out into the suburbs. Another possibility, in the past, maybe some parents with school-age children said, well, we have to live in this county because it's sort of compromised between commute and good school district. Now, the counties for school district opens up not only for one, but they can consider 5 or 6 different counties because they don't have to commute to office every single day. So that may begin to change some of the dynamics about residential choice as well. So the residential real estate prices already shown is rising, which is blue, but commercial real estate prices, overall, it is declining because of the difficult circumstance. So to wrap it up, economic forecast is 2020 middle column recession, 2021 positive, first because of the stimulus and the vaccination. But the concern is rising budget deficit that is pushing up the 10-year treasury, and therefore the housing market forecast is that mortgage rate will be ticking higher, maybe 3.1 in the summer, 3.3 or 3.4% in the by end of the year. But the average would be this. New home sales looks good. Existing home sales popping out at 15%. And I gave you the reason and the logic behind it. You know, some people are surprised that it could rise 15%, but the prices, I think the price growth will begin to tame down just because we will get more inventory from the builders. So with that, I am now going to turn it back and happy to answer any questions that you may have.
Oh, good morning, Dr. Yoon. That's terrific information. Thanks very much for that. I have gotten a few questions. And so I'm gonna, first of all, I'd like to do a couple of quick follow-ups. And I think you just answered this question with a comment, but you talked earlier about President Biden wanting to do an additional stimulus. And so it's your feeling that this is going to have a positive effect on housing. Is that correct?
So the stimulus that is being passed through something called reconciliation, which means 50 senators, which with the Democrats controlling the Senate, it can easily pass and it will go. And in terms of the job impact, it will be positive. But the negative side is that it's going to push up the mortgage rates. But I think the job impact, the positive will outweigh the negative impact of rising rates on the first stimulus. And then there's a second Biden stimulus, which is the infrastructure spending and other part, but that may require 60 votes in the Senate. So they have to get some Republicans to sign on to that, but that will be for later in the year.
Okay. You mentioned earlier, you talked about the lack of inventory. And you talked about how it seems that single family housing starts are ramping up a bit. And so one of the things we're really curious about is what can be done to, I mean, this inventory problem is obviously quite severe, quite serious. What could be done to help get things back on their feet, so to speak, if anything?
So, you know, things like material costs, which is rapidly rising. Is there anything to reduce the material costs? You know, there is still a tariff on Canadian lumber. I know that, you know, we should consider American business first, but sometimes if you reduce or bring more foreign product like Canadian lumber into the country, that means more job creation in the Chicago region, construction workers. And if there's more homes for sale, that means more business for realtors. So it actually facilitates more economic activity in the US if we can bring the Canadian lumber at cheaper prices. So that would be one. But the other, I would say, major part is just the zoning excessive regulation, because home builders are indicating that because of some of the excessive environmental regulation related to home building, that is all leading to additional cost pressures on it. So, that also needs to be considered about, what is the right balance on the regulation on the environment versus home building.
Mm-hmm. Is this something that's going to take a long time to address, a short, I mean, could it be fixed quickly, or is it going to take a number of years, no matter what the circumstance?
So I think the second stimulus that I mentioned, where it would include infrastructure spending, where you will need 60 Senate votes, so some degree of compromise, it may include this provision to say that we are going to provide infrastructure spending in the Chicago area, but you must relax some of the zoning regulation or some of the, because there's a lack of inventory. So they may put those conditions, which means that locals, in order to fix the highways, they certainly want to allow the builders to build more homes. So that's a possibility. And also we need to have more construction workers, people going into trade schools rather than going into only universities, because I think America may be overeducated in college and not focusing on the trade skill sets.
Earlier this week, Zillow's economic research team, they released their forecast for 2021 and stated that they expect it to be the best year for home sales since 2005. And in fact, their number crunchers, and I wrote this down, believe that a whopping 6.8 million in existing homes will close this coming year, marking the biggest one-year gain in sales, nearly 22% since the early 1980s. So, all right, are they close? Do you agree with this at all, or how would you temper that a bit?
So they are saying 22% growth. I put in my slide 15% growth. There's always some degree of errors, but this is saying this is going to be a good year. But in terms of the reference, getting close to 7 million home sales, I mean, those are, NAR data. We had 7.2 million home sales back in 2005. But again, that was artificial sales with subprime lending, but it could be the best year since that time period.
Mm-hmm. So we have reason to be quite optimistic about it. Maybe not record-setting, but optimistic certainly, right? Okay. We've talked a little bit about the pandemic. And I think too that for urban areas, there've been other issues as well in terms of maybe civil unrest, things like that. But there seem to be reasons for people to be looking towards moving out to the suburbs. And so I guess the question here would be, do you think that this is more or less a permanent change, or is this like a temporary thing where people are coming out, but then they'll eventually get back into the cities as time goes on?
People don't like violence, no matter what. Capitol Hill, to some of the street violence that occurred. People support First Amendment rights on protests. Everyone supports that, but people simply don't like violence. I think people are going to the suburbs, at least in 2020. Maybe they have that memory in mind. But the big reason for going into the suburbs is really work from home phenomena. I think many CEOs today are really struggling. How do we get the workers back to office, assume they are vaccinated, because they have demonstrated they could work from home productively. So I think it will be some hybrid, and that hybrid will lead people to say, well, I don't have to worry about those downtown commutes anymore, and they can now live in the suburbs much more comfortably.
You mentioned earlier, we've talked about the stimulus a couple of times. So let's go away from that. Other than the stimulus, new president, new administration, what do you see as the biggest impact this year in terms of the new president, the new administration, and what's going to happen with real estate?
So let me talk about possible third stimulus. So, first stimulus going, second stimulus could be infrastructure. The third stimulus, which is not really a stimulus, but more of a fundamental long-term policy shift, where President Biden did mention about a down payment assistance or a homebuyer tax credit so that people who are on more moderate income has a better shot at becoming homeowners, because homeownership leads to many great positive outcomes. So he's considering that. But he's also mentioned that 1031 exchange, which is very critical for sale of a land to home builders, that he may take that away because not understanding how it's used, other than, well, isn't this something hedge fund use, and there's a tax loophole. So we will be doing a lot of education about how our commercial members utilize that. Many of the land sales actually occur with 1031 exchange, and we need to build more homes. So if we cannot sell land to home builders, that will really lead to inventory crunch. So, but that will be considered more third round of discussion, not in terms of the context of stimulus, but broad sort of fundamental change about what the Biden administration would like to see regarding home ownership and other factors.
Mm-hmm. With the stimulus packages that we've been talking about, and it seems like there's along with that, we're going to have inflation, right? So we're going to have an increased inflation. I'm assuming, what are your expectations? Will we have inflation? How much is it going to affect us?
Yeah, I believe that we are going to get higher inflation. So the Federal Reserve has changed their policy stance. They always said that 2% inflation is sort of the limit. We don't want to go above 2% in terms of consumer price inflation, the price of tomatoes, gasoline, all of that combined. By the way, home prices are not part of that picture. That's not included. But the Federal Reserve has now indicated that 2% is no longer the limit. We want the 2% to be the average of multiple years. So some years it can be 1%, other years it can be 3%. But I don't think we will ever return to the 1970s style 10% inflation just because it was horrible. And economists who are making policy recommendation to presidents and other policy makers to say we never want to return to that period. But if we get to say 3% inflation, it just means that mortgage rate also would be commensurately higher, because as lenders lend, they're getting the money back in the future, but the money they get back in the future has lost in value. They said, oh, we didn't make any money. So they need to charge higher interest rate to compensate for inflationary expectations.
Can I have you talk in a bit wider frame of reference here about our friends in the banking industry? Okay, so other than just purely talking about mortgage rates, what role do you see the banks playing in this right now and going forward in terms of our real estate industry?
Yeah, hard to answer that question because of the Fannie and Freddie, whether it's the banking or not, the mortgages are flowing through. But I guess the bankings are important in terms of non-conforming mortgages. And maybe you have clients who use jumbo mortgages, and jumbo mortgages sometimes is easily available, other times it's less readily available. So that will be determined by the private sector banks without the Fannie and Freddie. And so far, the banking industry is in healthy conditions. Even during the recession, they actually had plenty of cash buffer to work with. So the banking industry, unlike 10 years ago with financial market crisis, bailout, all that talk is not present today.
All right, I've got one last question on my list here. So I'm gonna throw it out. We've had a couple of chat questions that I've been able to get to. So if anybody's got a question, maybe you wanna toss it in the chat right now. And Dr. Yoon, I'm gonna turn to you on this. And we've seen there's a lot of consolidation going on in our industry, but we've talked a lot about the associations maybe need to consolidate and the MLSs need to consolidate. But what we're seeing right now, right, we're seeing these large companies and they're buying different vendors, right, to add to their functionality. Zillow bought Dotloop, and now they're in the process of buying Showing Time. CoStar bought HomeSnap. Now they're still trying to buy CoreLogic, it appears. Do you see this trend continuing, and you think it's a good or a bad thing, or how it might affect us?
So, just looking at from economist point of view, we always like competition. So anything that brings competition to the industry is always leads to a good, healthy outcome, what is good for the consumers. Now, if Zillow and others are monopolizing because as they are taking away some of the leads, or they are selling the leads at exorbitant prices, it doesn't help the consumers. It just means that the people, real estate professionals who are involved in the business has to now cover that extra cost that they are paying for the Zillows, so the consumers ultimately pay higher fees on it. So given this dynamics, we need to assure that no entity, try to have market power. I would not say monopoly power, but large market power to control. So anything that leads to more competition would be a good. One thing that we find consistently when we take survey of consumers, were you happy with the realtor that you worked with in the recent transaction? And 80 or 90% of the consumers said, yes, I am so happy that I worked with this particular realtor that I worked with. The other realtors, there's some question about the other realtors, but the realtor they work with, they're so satisfied, which tells me that people are not going to do online everything on their own. They know there's as home inspection, mortgage financing, contingencies, all that part. So I think the consumers really value the professional guidance from the realtors.
I'd be remiss if I didn't ask you about what you're seeing regarding trends with affordable housing. Maybe you can comment on that for a moment or two for us.
So affordable housing is now shrinking in terms of the availability. And we had also an apartment shortage before the pandemic. Now, because of the pandemic, some people who used to live in apartments went to live with their parents. So you led to some increase in vacancy. But assuming that jobs recover in the second half of this year, I think the demand for apartments will come back again. We have shortage of apartment housing along with the home ownership housing, the inventory situation. So we have housing shortage overall, which means affordable housing becomes even more difficult unless there's a specific tax incentive for the builders to build affordable housing as they're getting some tax credit in return, or in opportunity zone where they defer some of the tax part as part of the infrastructure spending. Maybe they said, okay, here's the money to build highways and bridges, but here's also money to build affordable housing. So it could be in that context.
And I assume NAR is working on these things. Are you optimistic that we're going to be seeing that kind of help for affordable housing?
So our lobbyists and the advocacy team are constantly monitoring. But as we always say, the NAR is a member association. We certainly raise any alert that may be occurring in Congress, but it's all the committee works that committees determine, let's go for this. We think that asking for B is too excessive, let's trim it down. So it's the committee work that really helps. And the fact that you have the board of directors, that means they're very engaged in your local area, and some will be involved at the national levels and committee. And it's through all these channels that we determine what we really push for in Washington.
I do not want to forget to ask you to thank Caroline, who put together us being able to arrange for this. She was tremendously helpful. She's overly protective of you, by the way. I tried to and she wouldn't, let me do what I wanted to do. But anyway, no, thank you again for being here. Brad, I think I've gotten through all the questions, so I'm going to turn it back to you because I know you wanted to say something.
Thank you very, very much, Jeff, and thanks to everyone that posed a question that Jeff was able to ask today. Dr. Yoon, I'd like to thank you again for your time and your expertise and sharing your thoughts with us today. And I also want to thank our entire audience for tuning in today and participating in this presentation. I think on behalf of NSBAR, it's really been a great honor to have you join and visit with us today. So thank you very much.